A very good morning and warm welcome to Money Sense. Your hosts, as usual, are Christoph Barnett, Neville Hicks, and myself, Simon Caudry.
Morning.
Good morning.
We're delighted to be joined in the studio this morning by Simon Ecclefield. Simon is relatively new to... Well, good morning, Simon. Simon's relatively new to the island, having been an equity trader in New York and London for the best part of about 30 years. So, Simon, thank you again for joining us and welcome to Money Sense.
Well, thank you for inviting me.
Now, we're going to do something slightly different on the show this morning, whereby we're going to evaluate, as a group, with input obviously from Simon, what the world may look like in 2017 and a little bit of what's gone on in 2016. So this is going to be a show of forecasts, crystal ball gazing and potentially just random ideas, I suppose. Now, for obvious reasons, and I know we don't normally throw around lots of disclaimers, but today it is somewhat important to do so. The ideas and thoughts that we are going to mention are purely speculative and are going to be mentioned in order to give every one of our listeners ideas and thoughts for 2017. We don't want anyone rushing off to their broker after this to trade just because we gave out some ideas on this show. The purpose of the ideas is to stimulate thought and discussion, not to get people to go out and buy things. If you're going to go out and trade, do your own research and make sure it's appropriate for you. Now, with all that said and done, before we go on to 2017, we're still a few days left in 2016. And Christoph, let me hand over to you just to give us some context as to what the heck happened this year.
Thank you, Simon. Yeah, before we look forward, it's always good to look back and see where we've come. And I think 2016 has been a year of surprises, especially on the political front with Brexit and the Trump election results. And I think it's important to point out that when we look back at history, we see it as a fixed path, and it's almost like we look back and say, oh, it had to be this way. But in truth, the future is always uncertain, and what we see ahead of us is a range of possibilities with various probabilities, and especially of how close the results were, both in Brexit and Trump. It did not have to be that way. And a lot of the future is random, and there is luck on both sides. And so that's important that we look back on our investment results for the year, because what we need to do is not necessarily focus on the results from year to year, but make sure we have a sound process as we go ahead and talk about the future.
And I guess when everyone's thinking about what to invest in, it's the process and the methodology one goes through, which is vital, so that you've got a sound basis for any investment.
Absolutely, and also because when we talk about investing and we talk about what works in investing, works is a loose term, because in investing, works can mean it makes money 2 out of 3 years, which actually over time drives a lot of wealth. But if your car worked like that, you'd have problems. So it's important to have a sound process. And if this is one of out of the 3 years that didn't work, did you have a sound process? Well, look forward to the next 2 years.
Okay, now, big picture-wise then, when you gaze into 2017, and Simon's going to give us a couple of intriguing ideas on the stock side. Big picture, though, Christoph, where do you see 2017 evolving to? How do you see it developing? We start off with a new president and all sorts of things. Where do you think it's going to go?
What are your ranges of possibilities? It's a wide range.
I could give you a bull case and a bear case. So I could be an optimist or a pessimist, and usually the world ends up somewhere in the middle. But I think there's still opportunities in emerging markets just because of the valuations plays. I think not that everyone should be trading or day trading, but there will have to be more volatility. We've seen the measures of volatility have collapsed as the market just tends to drift ever and slowly upward. We've had spikes in volatility around the political events, but in the end, we've seen that collapse in volatility, and I can only imagine that volatility will go up, leading to more opportunities. So if you're looking to do some trading or some more strategic allocation, there'll be opportunities.
What about, we've now been, I think if we get through Christmas, we'll be in the second, that's all I'm thinking about right now. But we'll be in the second longest bull market in the U.S. ever. And I think if we continue to on that trajectory through Easter, it'll be the longest of all time. And, we were making a comment that even in 2015, it didn't feel terribly great, but we were still up on a total return basis, and that was the 7th year of positive gains in the U.S. It looks like we're going to finish this year, unless things go drastically wrong, again up So 8 years, and I believe that's a record. Is that a record?
Yeah, before last year it was 6 years.
Before
positive.
last year. So
The record was.
It kind of, I mean, I still think we still have the financial crisis in the back of our mind, but it's one of those things. If we're on the longest run ever, how much legs does this have, and how far of evaluation can this go?
Just before I throw it to Simon for his comments on this, I just want to, I don't think necessarily the time is important because, well, I guess the future's uncertain. But one thing that we've talked about on the trading desk is that the bull markets tend to end with euphoria, and I hadn't seen the euphoria in the last couple of years. But guess what? I think people are kind of euphoric now. If you're a small cap U.S. investor and you're up 16% in the last month, that's grounds for a little euphoria, which concerns me actually.
Well, Simon, let me address that question with you, because Neville's pointed out we are in a record bull market, and Christoph mentioned that we've seen markets drift higher in almost a way which has gone unnoticed. It's just continued to go up, and we've seen volatility at such low levels. In other words, the level of panic or nervousness people have about markets is so low. When you've been, I don't want to suggest you've got too many grey hairs, but in your times on trading floors, have you seen markets such as these where we've just seen continual movement higher with no one really worried or seemingly worried about things?
Well, I think people are still worried in certain sectors and certain spheres where you suddenly get panic, and we see that almost not daily but weekly in the markets. But what I'd like to do is point out that it might be a 7-8 year stretch that we're going through, but have a look at where we're coming from, which is that after the financial crisis, stocks basically dropped, nigh on 40%. So we're only just now, 7-8 years into the process, seeing the Dow being challenged for a new high. So we're really rebasing. I just see it as we're now starting on another level, and there is potential. I'm not saying the markets are going to go up forever, but there is potential that we've now rebased back to where we were 8 years ago. Mm-hmm. So from here to move on, I don't think it's that much of a problem.
Well, I think too, and Christoph, you probably know this a little bit more, but even if we go back to the tech, I think if we look over that period in the U.S. market anyway, I don't think we're materially up from then. I guess over the last 15 years, is that accurate?
It depends on the index. On the NASDAQ, yeah.
I guess correct. NASDAQ, yeah.
Especially inflation adjusted. But I think we're seeing meaningful gains, to Simon's point, in the Dow and the S&P versus those highs.
Yeah.
And the Dow is not necessarily a good indicator because it's only 30 stocks. But at the same time, we've rebased, and for me, it gives me a potential for a positive move to be continued.
So let me focus though on the volatility. Now, volatility is a concept which measures the level of nervousness, if you like, amongst investors. In other words, if stocks move by 3 or 4% in a day, people are obviously up and down. People are a little bit more nervous than if things move by 0.5% in a day. That's a very basic interpretation of it. And market movements have been very subdued on a general basis. Is that a sign of worry? I mean, the analogy might be the calm before the storm. When you see the ocean so very calm and flat, you might think that's a great day to go boating. Make sure you get back before the evening because the waves can come straight afterwards. What's your view on the level of calmness that we see in markets?
Well, I think the background seems to be calm, but on a daily basis, people are ready to run. There's a lot of fear factor ready to be pumped, which to me just shows that people are scared of being caught on the wrong side of a given theme or trade, whether it be a Brexit theme or a Trump theme. A lot of hedge funds this year still haven't performed particularly well. The indices may, the trackers might be in line, but there are still people in negative territory for the year. It's too late now for the catch-up, but I do think that within that sphere there's been a lot of reshuffling of what were good and possibly neutral positions, just to be able to try and gain some performance to continue to keep their investors happy.
What do you think then? You mentioned the word fear a couple of times. What do you think is the biggest fear that would cause people to panic the most, that's at the back of people's minds? So you've mentioned Trump, you mentioned Brexit. Those are sort of, they're done and dusted now, though, aren't they? Brexit's kind of, the votes happened. Trump, the votes happened. Italy, the votes happened. It seems as though all those things that we identify as being, hey, these could be really meaningful market movers, just been brushed off.
Well, I think there's been a lot more, let's call it an adult reaction to everything. Instead of being little boys caught with a parcel at the wrong time, I think people have been, okay, the trade has changed. And, looking at we'll start with Brexit, where the direction in Brexit is construction stocks got absolutely killed. That was an overnight reaction. There were stocks down 30, 40%. Brexit is going to take 2 years to achieve, probably longer, the way things are going. The reverse side is Trump, where obviously he's going to start spending on the infrastructure and all the rest. Construction stocks have gone through the roof. I mean, we've got two counterproductive trades which are balancing each other out. And I think we're going to see there's a lot of that in the background. So the element of panic that could be there is being offset by another issue, which is acting as a balance.
But isn't that, kind of both those knee-jerk reactions are just kind of human elements of saying, well, Trump is going to, there's going to be fiscal stimulus. I mean, the reality is how long is that going to take to actually trickle through the system and actually be productive from an economic standpoint, whether it's job growth or whether, it's increased spending and that multiplier flowing through the economy. I mean, the reality is does that justify construction company stocks jumping by 20% right away?
I think it sort of does. It's more the perception of. It's almost like, I'm old enough now that you mentioned grey hairs, but it's almost like when we go back to when sterling basically went to effectively parity against the US dollar, which there's a lot of people around who haven't been there. The actual turning point was at 103. It never hit 100. And the reason for that is that there were so many people waiting for the activity to actually happen that by the time they thought it was going to get there, the contra trade just kicks in and it saved the currency in that regard. So you either completely overshoot a level or you never actually get there. And that's one of the throws about investing. It could be one or the other. But basically, that sterling trade is a great example. Everyone was waiting for it to hit parity. Never did.
Yes, well, so let me move the conversation on then to sort of another big picture topic, which is the oil price. And we've had a lot of conversation about OPEC in the news, about OPEC's actions. What I would like to do is just sort of set the scene, and then perhaps after the break we'll address this. But the scenario then is you've got a situation where OPEC is talking, and this is the oil producers in the Middle East and such like, are talking about curtailing production in order to stimulate prices. So my question then, which perhaps we can address after the break, as I say, is that a good thing for the economy because it creates wealth in the oil-producing sector, which has been a laggard of the past 18 months? Or is it actually a negative for the global economy because it starts to raise prices? Input prices go up. The cost that people have when they fill up their car with petrol goes up. So let's perhaps take a brief break right now and then come back after the break and discuss that.
Yeah, that's a big question.
Welcome back. In the second half of today's show, we're going to continue our conversation with Simon Ecclesfield and the hosting team here about the outlook for 2017. As we led into the break, I posed the question about the oil price and the impact of OPEC and what that might mean for the global economy. Neville, do you want to take the subject to the macro picture of what that might mean, and then perhaps Simon Ecclesfield can discuss some implications on stock ideas?
Sure. And yeah, feel free to jump in, guys. But I think with, oil, we've seen a massive shift over the last 2 years. OPEC obviously have reached an agreement to reduce production. They've also got Russia on board. Now, whether or not they might say they might be cutting production, whether or not they actually cut production, I think is a bigger kind of more broad-basing fundamental question. I think there's a couple major challenges within the oil industry. One is the secular challenge. So people are economies are still growing, population's still growing. We're still using more oil, but the rate at which we're using oil is diminished. So that's driven by technology. So we've got solar, we've got Elon Musk with Tesla, who's got roof panels that look like shingles and generate a ton of electricity. We're seeing more and more electric cars. So we're seeing, kind of a shift in that side. I think what we've, getting back to kind of, I guess, traditional economics where we look at supply and demand and what should drive that. I don't think the oil industry is rational when it comes to that. Obviously, you've got various countries, various companies who have different marginal costs, and whether or not they're pumping or not doesn't really necessarily matter on what the kind of fundamental cost is, and that kind of creates this irrational behavior, and that's why we've seen kind of such a volatility in the oil price. I think one thing that we've seen, and it'll be interesting because oil now is at, I think it's close to a 12-month high.
54 bucks.
54. So, the range that we've been seeing is kind of the 60 to 40. And a lot of that now is driven from the fact that the U.S. is really energy independent. So, you look at a chart of oil prices and then a chart next to it on rig count, and they are basically correlated 1-to-1. So as soon as oil starts picking up, rig count follows basically to the month, which is a very different dynamic than we had historically, which was really led by the Saudis.
And let's just interrupt you for a second and just define what we mean by rig count. You're talking about companies going out and drilling holes to find new oil. So the price goes up, people go, hey, I can make more money, therefore I start drilling.
Yeah, and I think, fundamentally that, and it's more on the fracking, U.S.-based side, and it's technology-wise, the technology's there to kind of more flip a switch, and I think that's, so we're probably going to continue to see this range of it bouncing around. I think the days of $100 oil are gone, unless someone nukes Saudi Arabia or there's some other major global crisis.
Well, let's not hope for global crises, especially nuclear ones. But let's turn then to you, Simon. We've seen the OPEC decision. Neville's sort of talking about the $40 to $60 range. Does that lead to potential investment opportunities in the energy space? And where would you, if someone's looking at that, what's your trade idea for people?
Okay, so this is the first one where people can shoot us for.
I'd shoot you for the record.
Or shoot me for. I've selected Royal Dutch Shell. The ticker that I'm going to use is RDSB for boy. Large company, we all know it. Market cap of about $220 billion US. It pays a dividend of $3.76. That translates into a current yield based on the last share price, this is yesterday's price, so I apologize, I haven't seen the markets this morning. Yesterday's close was $57.79. You've got a yield of 6.63% on a monster company that is basically well set for the oil price, whichever way it goes. They know how to cut costs when it's time to cut costs. And if the pumps are switched on again, they're going to benefit from that because throughout they've been exploring. The reason for choosing that ticker is it has a dual listing, which is the RDSB is the sister ticker, but that one has Dutch tax implications on the dividend. There's a withholding, and I get confused. It's either 15 or 25% withholding on the dividends related to that. So your payback is actually lower. But I think that's a big, very simple company to be involved in that theme.
So let's put that into perspective. If I were to go out and buy a US government 10-year bond, in other words, issued by the US government, I'm going to get my money back in 10 years. I put $100 in, I'll get $100 back. I'm going to be earning right now about 2.6% per year. What you're saying is there's a company, an oil company, so subject to the vagaries of the oil price and the market and all those sorts of things, which is paying me a yield of about 6.6%. Now, if stock goes down 6.6% each year, you're going to be no better off. You're going to be worse off, obviously, than you would have been by owning a treasury. But that's quite a good yield. I mean, why are they able to afford to pay such a yield then? What's unique about them, or is there nothing unique?
It's not so much unique as just I think it's a misprice in the share price, to be honest. We are, and I do give out the warning on this, we're trading near the year high. So if you want to be opportunistic and just wait for the stock to settle back some, its cash flow covers the dividend extremely competently. I haven't got the multiple in front of me, But when you have a company like that that's paying that sort of yield, I think it's almost a no-brainer.
Well, there you go. There's stock idea number one. So let's go back, if we can, just to think about a big picture macro idea, and then see where that leads into other trade ideas. So Christoph, when we're talking other macro themes, perhaps for 2017, what else is front and center of your mind when you're looking ahead?
Well, I think interest rates are a big topic. So we've seen interest rates since the Trump election in longer bonds, 10 years and beyond. The interest rates have risen dramatically, over 1% from the lows in the last year and a half. So on that 10-year bond you were mentioning just now is at 2.5%. Well, it was 170 earlier in the year or lower, and so what that translates to when interest rate goes up, the price of the bond goes down, and so there's opportunities for people looking to maybe reinvest in bonds. Now you have to be careful because interest rates can continue to rise, and today we're going to have a announcement from the Fed on the short-term interest rates.
And generally, when interest rates, just to remind people, when interest rates go up, bond prices generally get crushed. In other words, they go down a fair bit.
Absolutely. And so what we've seen on the 20-year bond, which shows the most dramatic move, an over 16% decline since Trump was elected. Now, they had been participating in massive gains, so I think they were up 16% for the year before that, so some of that gets offset. But now there's opportunity to reinvest some of that cash that maybe is earning 0.5% or less in the bank, maybe. There's opportunities if you need that security and can't handle the volatility of the equity market. There's opportunities to reinvest in bonds.
Okay, and the theme there is higher interest rates in the US, particularly in the US and potentially in other markets. So let's take that into actionable items, perhaps. One of the sectors in the economy that does very well, generally speaking, when interest rates go higher, is the banking and the financial services market. The rationale being that banks can continue to pay zero on their bank accounts to people, but they can charge more on the lending rates, and therefore the margin they can earn, the spread they can earn goes up. Perhaps, Simon, you have some ideas on the banking space that we should be considering, and give us some reasons for that.
Again, I'm working on a tilt in the ADR market because of the tax implications of dividends. Take your own advice from your financial consultant before you take this as gospel.
Noted.
A bank I picked on, which happens to be an old favourite of mine because, in fact, two of us in this room used to work for them. Barclays, the ticker is BCS. Market cap just short of $50 billion US. Last price, just so we can have an idea, is 11.62, which was last night. It's had a year high of around 13.5 and a year low. This is all pre the recovery in the financials of 6.76, which is probably Brexit related. That pays 38 cents a year in dividend, which gives you a yield of approximately 3.28%. The interesting thing that I saw here, the short interest on the shares, which means the number of people that are short the shares looking to underperform, is 0.12% of their share capital, which is very, very low. The technical unwind is about a day and a half, which compares to about a month ago when it was about 3/4 of a day for the unwind of the short position. It shows a little bit of a pickup in the short, but at the same time, you're looking at a bank that people don't think is going down. I think that when you have a yield like that, you've got the financial play that we've already commented on, and the current share price, which is sort of not quite halfway between its year high and low, another interesting play.
Well, let me dig into that a little bit more, because you used a few words there that I might not totally understand. So short interest and short position. If I understand it correctly, what you're saying is that there are people out there who think the stock is going down, and the way they express it is to sell something they don't own, so short it in the jargon.
Correct.
And the number of people betting that way on this particular stock is at a relatively low level. In other words, there are fewer people than a few months ago who are now betting that this stock is going down.
That's correct.
Okay. Now, Barclays is a European or UK and UK-based bank. Is there any anxiety that you have with respect to what might happen because of Brexit negotiations and interest rates in the UK not necessarily being the same as interest rates in the US and in terms of direction at this particular moment? Are you anxious at all about that as an implication for the stock?
No, because that brings me on to a couple of other points about it. The first is that Barclays is a global bank, and we must remember that. It's got a footprint globally. The second thing about Barclays is that it's actually undergone or started a restructuring, which is going to involve the sale of their African assets. Now, this is all recovering from a crisis low when things were just going horribly wrong. I'm not saying this bank's going up forever, but I do think it's got as good a chance as any other bank of moving.
Okay,
positively, that is.
Fair enough. And anyone else want to jump in on the financial space?
I think the financial space is interesting, like just with everything that's happened in fintech and I guess traditional bricks and mortar banking. What about blockchain, or what about all these things that have kicked off?
I have no idea, mate. It's far too confusing for me to understand.
I guess
jump in.
I think that the traditional bricks and mortar bank, we're always going to need kind of international finance and whatnot, but you look at places like in Africa who don't even really use banks; they use mobile phone companies to transact. What happens when the U.S. dollar is not the global currency? I mean, this is kind of getting ahead of ourselves for 2017, but this is, I think these financials are structurally going to be, have issues.
I think I take your point, but the one thing about blockchain that I would stress is right now it's unregulated. It ain't going to be the way of the future.
Until it gets regulated.
As soon as regulation comes in, that telephone in Africa is not going to be able to transmit that money that quickly.
Okay, so we've got about 50 seconds left of conversation time before we have to wrap up. I want people to be prepared for something bad that might happen in 2017. If things all go wrong, the world starts to get depressing and miserable, what particular stock are we going to go for then, Simon, to make us all a little bit happier?
On the safety?
Well, no, not on the safety. What, you got something to make us happy and just to take our mind away from all the miserable?
Well, I've got another one. Short interest, below 1%. It's called AstraZeneca. Great big pharmaceutical.
So we're going drugs.
I thought we were talking about legalizing cannabis.
Well, I was going to nip over to that, but I do have the happy one, which is it's GW Pharma, which again is in the space. It's about a $2.9 billion stock. Short interest on that, seeing as we like that word. It's about 11%, so it's high. So people are taking a bet both ways on this one. It doesn't pay a dividend because it doesn't have any real earnings. But at the same time, if you want to play ganja, this is your baby.
Play ganja.
I don't know what to make of that particular line of commentary in terms of whether we want to play it or not. But they are legally manufacturing the product, and obviously it's becoming increasingly allowable in a lot of countries around the world, Jamaica and many states in the US.
Well, I think
Jamaica legalized it.
The big one is California, right?
Yeah,
California is the sixth biggest economy in the world, and they've legalized it, and I think from there it just is definitely build some momentum.
Absolutely. Now, I'm afraid, Simon and guys, our time is up this morning, and I'd like to sincerely thank you all for joining us on the show. And I do need once again to stress to all of our listeners that we've heard some ideas here in terms of individual stocks. I want to encourage you not to go crazy and rush out and buy or sell something just because it was mentioned here. If you do and it goes wrong, don't blame the hosts. That's a subtle dig at the guest.
And certainly don't blame me.
No, but in all seriousness, things do move in unexpected and often undesirable ways. So before you go and buy or sell anything, do your own research and be careful. As a final note before we leave, I wish to once again thank all of our listeners and remind you that today's show will be available as a podcast on the CFA Society Cayman Islands webpage. I encourage you, if you have a question, to tweet us at Money Sense Radio. That's at Money Sense Radio. Post any questions or comments there. We will reply. With that, thank you once again. Goodbye. And I guess Happy Christmas and Happy New Year. This will be our last show of 2016, if I'm not mistaken.
Yeah. Have a safe and wonderful holiday season. Absolutely. And we'll look forward to rejoining you in 2017.
Money Sense is brought to you with the support of One Trade X. One TradeX, the Cayman Islands' #1 choice for online brokerage.